Hi everyone, I'm Janeline Polonio and I'm here to discuss with you the presentation of projected financial statements. And at the end of my discussion, we're asked to understand the use of projected financial statements and learn the preparation and process of making performance statements. But first, what is projected financial statements? Projected financial statements are an important tool in determining the overall performance of the company in the specified following years. And this incorporate the current trends, the expectations that to arrive at a financial picture that the company wants to attain at a certain future. Like for example, in the 3 years, in the next 3 years, or in the next 5 years. And in creating the financial statements, we are going to use the forecasting, the cash budget, and the capital expenditure that has been discussed by the previous reporters for us to get the projected balance sheet, the projected income statement, the projected cash flows, and the projected statement of owner's equity. Because it is very important because those results that have been reported by the previous reporter will reflect to the projected financial statement. So moving on, we have here now the guidelines in preparing the projected financial statements. First is to review or lift your projections based on the movement of accounts. It is very important to review the movement of the accounts because there's a lot of factors that affect the movements of the accounts. For example, we have to consider the economic status of our country today and see the effect of the inflation rate, the GDP, in every sales that we're going to do and in every account in the financial statement. And also, we can also consider the factors that, for example, the policies that has been creating, what are the effect of these policies to the performance of the company in the next 5 years. Next guideline is to integrate the estimated effects of the implementation of the plan based on financial assumptions, cash budgets, operating and capital expenditure budget. These things have been discussed by the previous reporter also. And it's important because the results here are reflected to the projected financial statements. And lastly is to adjust the accounts correspondingly for consistency and balancing of the projected financial condition. Because it is very important for us that our final projected financial statements are consistent and balanced, since there will be a lot of changes when we're going to reflect already the the movements of the results in the previous studies to the projected financial statements. And let's now move on to the steps involved in the preparation of each projected financial statement. First is to project sales revenue. In projecting, this step is very important since projecting sales revenue will affect the accounts in income statement and also in balance sheet, especially in income statement. Because in sales revenue, we have here how, for example, the sales, the amount of and now let's see the steps involved in preparations of pre-forma financial statements. First is to project sales revenue. Projecting the sales revenue had been discussed by the previous reporter, and it is very important in creating the pro forma income statement and balance sheet, since the sales revenue will be integrated to the income statement and balance sheet. And the second step is to project operating expenses and derive projected operating income. And of course, by getting this, we need also to look back to the first step. Then, the third step is to project the assets, liabilities, and shareholders' equity. By getting this, we'll be able to know the future level of payables, receivables, and the borrowings, and anticipate also the profit of the company. And the next step is to determine the cost of financing the capital structure derived in step 3. In determining the cost, it can be done by studying by the use of forecasting that is reported by the previous reporter. And the last step is to derive the statement of cash flows from the projected income statements and comparative balance sheets. So these steps the the processes that is very helpful in creating the projected. We have here an example of the New Pingping Lechon Incorporation projected consolidated income statement. And as you can observe, it is only a 3-year projection, but it can be 5-year projected income statement also. So as what you can observe, it is written like this. It started at the first year of your projection is written at the left side, right after the account titles, and it is followed by the upcoming years going to the right side. In preparing the data for the projected financial statements, we could use the questions in the financial assumptions, like in sales. In sales, it is there is an assumption that the sales will increase by 8% annually. So as you can observe, it is increasing by 8%. So from 38.7, it increased to 41.8 up to 45.2 at that 3rd year. And also, another assumption is that the rent will never increase at all. So as you can observe, the rent is 900K, still 900K, and still 900K. And we can also use and to get the data for another accounts that is not affected by the movement of the accounts, with the results of the forecasting, the cash budget, and the capital and expenditure budget, we can use the help of common sizing. In using the common sizing, we'll be able to get how much the account increased for the first year to the last year. Using the projected financial statements will help us to determine the performance of the company for the following years, and this will help us to see if there are events that may go against our plan, and for that, knowing that things, we'll be able to make some adjustments in our accounts to continue performing well and operating well for the future of our company. That's all. Thank you.